Investments are like marriages. There are ups and downs, and what gets you through the downs is the ability to communicate in a very transparent, candid, open, safe way. So you have to fundamentally be working with people, ideally that you like, but you have to trust them and respect them.
This is Net Learnings, the podcast that keeps finance and banking professionals ahead of the curve. In each episode, we focus on career growth and practical advice, while mixing in the occasional war story. Join us as we tap into the minds of leaders and experts at some of the world's most notable financial services firms and enterprises. Let's get started.
Hello and welcome to another episode of Net Learnings. I'm your host, Kyle Peterdy. I'm thrilled to introduce our guest today, Kristi Miller, Managing Partner at Krystal Growth Partners, a boutique private equity firm based in Vancouver, Canada. Kristi brings 25 years of finance and entrepreneurship experience across private equity, venture debt, subordinated debt, and commercial banking, just to name a few. Not to mention multiple board appointments over her illustrious career. Kristi is highly respected by both financial services professionals as well as Krystal's operating partners in the business community all across Western Canada. And it's my pleasure to welcome her. Kristi, thank you for joining us.
Thank you for having me, Kyle. This is going to be fun.
Kristi, there are a lot of directions we can take. Some of the stuff I want to cover today include, I want to talk about your firm. I want to talk a little bit about private equity more generally, but I really want to spend some time discussing your career in more detail and to try to tap into some of your wisdom for our listeners. But maybe first, tell us a bit about Krystal Growth Partners, please. KGP?
Absolutely. So Krystal Growth Partners, as you mentioned, is a boutique Vancouver-based private equity firm. We really do two things. 80% of our time is spent doing traditional private equity, by which we mean, we're investing in Western Canadian companies that have $2 to $7 million of EBITDA, generally enterprise value of less than $50 million. We look at companies in almost any industry. We don't love extractive industries or highly cyclical industries, but we'll invest in just about anything else. And we typically take control positions, so 50% or more of a business. What we're trying to do effectively is, buy a business at a reasonable valuation, build value over time, help the platform company make subsequent acquisitions. We call them tuck-in acquisitions, so that they grow both organically and through acquisition. And then after anywhere from 5 to 12 years, we resell the business for more than we paid for it. So that's 80% of what we do. And we refer to that as traditional private equity targeting the lower mid-market. The other 20% of what we do is really focusing on what we call Series A investments. So these are companies that tend to be smaller, earlier stage. The geography is a little bit more focused. We're really focused on BC-based investments and teams where we know the key executives to be people of really unquestioned character and integrity. And there's good evidence of traction. And those investments we tend to make on our own, whereas the traditional private equity investments will often partner with other co-investors on transactions. So 80% traditional private equity in the lower end of the mid-market, and 20% of what we do is what we call Series A investments.
And so Series A, that sort of creeps over the line into, I guess, venture, right? Is that kind of venture investments?
Yeah, that would be venture stage. And typically, I think they say there are 4 or 5 T's of venture, traction, technology, team, time, and I think there's one more that I'm forgetting. But they're earlier stage businesses, and there are different drivers of value at that stage. So we're looking for different things. On the traditional private equity side, these are established, relatively mature businesses with attractive growth prospects, but they're already profitable, they're already cash flow positive. On the Series A side of the business, they are almost certainly, if we invest, in revenue, but they may not be profitable yet. There's some big tech investment or some big investment designed to fuel growth, but they're not going to be at that same level of profitability yet. So the risk profile is higher, and it is more of a venture portfolio or venture profile.
Okay, interesting. I guess it's maybe the business enthusiast in me, but I always want to try to unpack competitive advantage and strategy. So in terms of portfolio construction, what's the rationale in working with companies in that sort of size bracket or that snack bracket? Is it market dynamics? Is it local competition? Is it return profile? like the 2 to 7 million in EBITDA range? What sort of drives that?
I would love to say that it's, very strategic, but really it's a function of experience and familiarity and where we feel we have some superpowers. My business partner, Terry Holland, and I, this is where we've spent our careers, working with companies at this stage, helping them scale up. Ultimately, portfolio companies tend to be acquired by either a strategic player in that industry or by a larger private equity fund. And so we're moving companies up through the food chain. We know this size and stage of business very well, and we're well experienced at helping them grow. We really lean in and help them, negotiate, find, structure, diligence acquisitions. We help them from a governance and oversight perspective as they integrate those acquisitions. And we know how these companies operate. We've seen lots of industries, lots of management teams, but we know this size and stage well. So we continue to invest there because we know what we're doing. We've got experience. We have established referral channels, but we've also got a great reputation in the marketplace because companies at this stage hear from other companies at the same stage that we've added real value. And our approach is different. We're not a fund in a typical sense because what we'll do is we'll be the lead investor on any given platform investment. And then we assemble a really bespoke group of co-investment partners, ideally many of whom will bring superpowers, specific domain expertise that's relevant to a particular business. We put together, a special purpose vehicle through which we invest. We hold that investment for as long as it makes sense for both the investors and the management team, but it's not a fund. And fund structures are different, right? Funds invest in a basket of investments, all with the same partners, and typically have a 10-year fund life. And so what that means is if you're at year 7 or year 8 of a fund, you might be forced to start thinking about selling a business because you need to wind up the fund and go raise the next fund. Right. Whereas the way we do things, we only sell a business when it's the right time to sell the business, the right time in the market, the right time for the management team, the right time for the investors. And so that means that our returns tend to be stronger and we don't end up with any ruffled feathers because we're selling a business before the management team is ready. So that was a really long-winded answer. I'm not sure if it kind of gets you where you need to go, but we invest in this space because we know it and we have a great reputation. And our competitive advantage flows both from that experience and reputation, but also from the way we structure deals. It has real advantages over a traditional fund structure.
That's a great answer, very detailed, and I appreciate it. Can I ask kind of a silly question? Because you mentioned larger firms, which we would think of as sort of like a traditional firm, like a KKR or a Blackstone. If KGP is a boutique firm, is boutique just another way of saying small? Like, what does it mean to be a boutique firm? Maybe you could help us unpack that a bit.
Yeah, fair enough. So lots of larger private equity funds have raised huge amounts of money. I had coffee with a friend 3 weeks ago in Toronto. He's with Birch Hill. Birch Hill currently has $1.8 billion in funds under management. They have to write minimum $10 million checks, but more like $40, $50, $80 million checks in order to be able to deploy the assets that they have raised from their limited partners. So they're doing bigger deals in bigger companies, which is great. And lots of firms operate like that. There are many, many large private equity firms. And, some of the ones that you mentioned are larger still than Birch Hill. But There are lots of companies that play at that end of the market. We don't write $80 million checks, right? We will write checks of between $5 and $10 million. We will raise co-investment. We did a deal last year, for example, approximately $45 million enterprise value, half financed through debt, half through, a network of co-investment partners. We wrote the largest check and we brought in a dozen or so investors to write smaller checks, which in aggregate got us to the equity requirement on the deal. So we don't have as much in terms of investable assets as a Birch Hill. We're targeting a much smaller end of the market, so fewer dollars, smaller companies, but there also aren't as many players at that end of the market. So if you know that space, private company dynamics, private company sort of markets, how management teams work at that stage, and in this place, in BC, almost all companies are mid-market companies. When you move into larger jurisdictions, larger markets, you get bigger companies, but in BC, I would argue that there might be 10 or 20 really, really big companies that aren't publicly traded, most of the activity happens in the mid-market and the lower end of the mid-market. And so we play in the mid-market because that's what we know. It's where we live. It's where the volume is. But you're right. It's also, where we can have influence with the number of dollars that we have to deploy.
Another, really good answer. Thank you. So obviously we don't want your secret sauce that's proprietary. And you mentioned, really, really top shelf management teams is something you look for. Are there any other kind of metrics that you're particularly fond of when you're assessing these companies, like thinking, lifetime customer value divided by customer acquisition cost, churn? Like, is there one metric that's just signals and screams winner to you, like that you're fond of?
Well, when you talk about sort of some of the metrics you refer to are very tech specific, and our portfolio isn't tech heavy. We'll look at tech, and in fact, we're doing more and more tech as the world develops, because eventually everything will be tech. But really what we're looking for is, first and foremost, good people. Are they smart? Are they aligned? Are they motivated? Are they fun? No jerks. We don't want to deal with people that we don't like, because investments are like marriages. There are ups and downs, and what gets you through the downs is the ability to communicate in a very transparent, candid, open, safe way. So you have to fundamentally be working with people, ideally that you like, but you have to trust them and respect them. So no jerks. That's what we're looking for first and foremost in a management team. Alignment is also really, really important. Do they have options? Do they have equity? Are they incented to grow the business? Are they incented to think like owners? So there's a huge qualitative piece and a structural alignment piece that we look for. But what we're looking for, above and beyond that, is a business's ability to generate positive cash flow, right? So we're not necessarily investing in cash burning early stage tech businesses in the hope of a strategic acquisition inside 18 months. That's really not how we play. There are investors in the marketplace who do invest with that kind of philosophy, but our approach is really looking for great teams with a proven ability to generate cash flow, sustainable competitive advantage, a logical buyer at the end of the day. And we work with those teams. We lean in, we support them to grow organically. So build a better mousetrap, better production flow, better premises choices, stronger teams, better governance, better internal systems, better ERP, better financial reporting. We also work with them to identify, diligence, structure, and integrate acquisition targets so that at the end of the day, they've grown both organically by building a more solid foundation, but also they're acquiring suppliers, customers, competitors, expanding geographically through M&A activity. And we put those two things together, and when the time is right, we market our businesses. But we're really looking for good people who can generate cash flow through both organic and inorganic growth.
Brilliant. Okay. I want to move on to some career stuff, but maybe we could pause and play a little game. What do you think?
That sounds fun.
Okay, so we're workshopping the name, tried this a few times. I'm tentatively calling it Middle School Money Manager. And the theme is, I'm going to give you a term, a finance-related term, and you need to explain it as though you were explaining it to a middle schooler, right? So the rules are relatively easy. I'll give you an example. So I'll use private equity, and you've just described it very nicely, but I'll try to describe it for a much younger audience. If I were explaining that to a kid, I might say something like, assume you run a lemonade stand. Maybe it's going really well. You're able to expand it to 5 stands. But at 5 stands, you realize it's getting really hard to manage. I can't keep riding my bike around town. My classmates are stealing from me. This is really hard. Well, what if I told you there was a way to take on a partner that could help you grow that lemonade empire to maybe 10 or 15 stands and help you with the management and the strategy? Well, that's private equity. The only catch is, in exchange for the cash and support today, you have to share future profit from the lemonade sales. How is that?
That's pretty good.
Okay, thank you. I was a middle school teacher at one point in my career, but that's another
There you
story.
go. You've got a leg up on this.
Maybe an unfair advantage. Okay, so I have a couple of words for you. The first one, LBO.
Well, it stands for a leveraged buyout. Basically, what an LBO is when you go in to buy a business and you want to put as little of your own money into it as possible. And so you go to the bank and you borrow as much as you can from the bank to finance the purchase so that you don't have to put in as much of your own cash.
Sounds risky.
it is risky. Leverage can be very risky.
Amplify returns and losses.
Totally. It's a gamble, right? If things go well, you'll make off like a bandit. If things go well, your reputation will be trashed and your tail will be between your legs.
Got it. Very well. Yeah, and all those lemonade stands out to pasture. Okay, that was good. That was really good, actually. Let's try another one. Covenant.
Covenant is an interesting word, and it means promise, right? A covenant is a promise. And it's most often used in finance circles to talk about the types of promises that a bank wants you to make in order to know that their loan is being well taken care of. So a covenant is a promise to the bank to behave in certain ways, to only take on so much leverage, to maintain a certain amount of cash in the business, to be able to demonstrate that you're making enough money to afford the different types of loans that you take on.
That was really good. You're really good at this.
Awesome.
All right, let's do one more because this one's hard. And to be honest, I've sort of added to the list for my own benefit. Can you please explain to me what a warrant is?
A warrant is a piece of paper that they issued in the Wild West for someone's arrest. No, a warrant is, maybe there are some similarities with that kind of Wild West reference, but a warrant is basically an option that you get to do something in the future at a certain price, but you negotiate it today. So a warrant gives you the right to acquire a piece of the business a little bit more than you currently have at a rate or a price that you negotiate in advance. So it's what we would call a sweetener, right? It makes the deal sweeter because the intent would be for the investor to get more of the company at a very favorable price, at a good price. So it's a sweetener. Okay. It enhances returns for the investor if it's in the money, but that's maybe getting too complicated.
That's getting a little advanced. Okay, no, that that was really good. I'm impressed. That was 3 really good explanations.
I thought the covenant one was the winner. That was the clearest.
It was really good. Yeah, it was really good. I might actually watch this recording after and circle back to some of our courses to make sure I'm explaining it appropriately to everyone. All right, let's move on to some career stuff. You didn't start in private equity, and actually you've had a very interesting career path. So I've cherry-picked a few financial services specific roles that I'd like to discuss. Let's wind back the clock a bit and start with your role at CIBC. This is a large Canadian bank for all of our non-Canadian, non-North American listeners. They have operations both in Canada and the US. And this one's close to my heart because I was a commercial banker for many years. You worked in commercial banking. What was that like?
It was boring, to be honest. It was. So I found it a very good education. And there's some backstory to this. I had been working overseas and fell into finance by accident after a rather unconventional undergraduate degree in history and Russian studies. So I spent a few years working for the European Bank for Reconstruction and Development in one of their funds in St. Petersburg, Russia. And it was wonderful. And that's a whole adventure. Actually, I call those my adventure capital days. But when I made the decision to come back to Canada, I was looking for something in my field, but I was still pretty early in my career and had no domestic experience. So I landed in a general management training program with CIBC. And it's a big organization, and the training program was solid. And initially, I was placed in a private banking role. And I'm going to be super candid and cheeky in this chat, given your audience. I was on the job for a couple of months, and I went to my boss at the time and I said, okay, here I sit in private banking, focusing on wealth management. And I said, correct me if I'm wrong, but it feels like sucking up to rich people. And my boss laughed and he said, yep, that's it. We're providing sophisticated wealth management advice to high net worth clients. And I said, my heart and soul is really on the commercial side. I want to be working with entrepreneurs. That's why I got into finance. That's what I enjoy. I like the can-do attitude of entrepreneurs, their yes, we can attitude, their ability to innovate and overcome, their grit and their resilience. And so I said, I want to be working in the trenches in a really grotty commercial branch. And my boss said, are you sure? You realize you've got a super plum posting here. Are you sure? I'm like, yeah, I'm sure. And so I went to work at a CIBC branch at Granville and Dunsmuir in Vancouver, which is now a Shoppers Drug Mart. At the time, it was the easternmost branch for CIBC in the downtown core of Vancouver before hitting Chinatown. It was super sketch. It was super marginal. We had homeless people sleeping in our ATM vestibule every night. But I mentored with a woman who is just an institution in terms of commercial lending. And I cranked through a bunch of volume. I did everything from learning how to finance commercial fishing licenses to how to finance a software business. So I saw tons of volume across a very wide range of industries. And I worked with a woman who put me through my paces. I learned so much so fast from the best. And it's an experience that's unmatched in my career in terms of the range and volume that I saw. That said, what struck me after the end of a couple of years is that so much of commercial lending is very formulaic. It's a high volume, low margin environment. And I decided that I wanted to develop closer working relationships with entrepreneurs to be able to provide more creative structures. I wanted to get away from senior secured lending to do things that were more creative and more bespoke. And so I left CIBC after a relatively short period of time. I was only there for 2 years. I learned tons and made friends that I have to this day. In fact, the woman who mentored me just retired 3 weeks ago after, I think she spent 56 years with CIBC.
Incredible.
So it was totally incredible, but it's not where I wanted to spend my career because at the end of the day, it was too formulaic.
Yeah, fair enough. A really good answer. And I think a lot of people find that. So then you moved over to Vancity Capital, right? And for our listeners that aren't familiar with it, Vancity is a fairly large credit union in Western Canada. And Vancity Capital, I think, is probably best characterized as like a growth and transition arm, I think, right? Is that sort of like that was venture debt and subordinated debt?
It was at the time. So at the time, Dave Mowat had actually been brought over from the Business Development Bank to start up this operation. It was initially called the Regional Development Corporation. The name evolved over time, and it was very much a subordinated debt shop. And we took a fund, I think I was employee number 3, and we took it from, a loss-making operation with a very, very small book to one that was, a nice, tidy portfolio generating a meaningful return for the credit union. Vancity Capital doesn't really exist today. It's been repurposed. The team turned over significantly in 2009 and 2010. And Vancity Capital morphed into more of a fund of funds strategy. So there are some people there who focus on more, I would say, alternative asset classes, but they're not doing direct deals. They're really investing in funds. So the strategy has changed quite a bit since the 2000s. So I would say that our heyday was really between 2000 and 2010.
Okay. I feel like I crossed paths with a lot of sub-debt providers and other sort of private non-bank lenders during my time in banking. What, in your view, are like skills that are an absolute must if you want to be successful in the sub-debt game? Like, is being good at senior lending a really clear path, or are there really different and unique skills that set people apart in that area?
Yeah, it's a really interesting question. So I think that good credit chops are useful to pretty much any industry, anybody who's an entrepreneur, anybody who's involved in finance. I don't think you need to spend a ton of time there to learn the basics, but I think good credit chops really help in terms of learning to structure deals. And I now have the dubious distinction of being able to say that I have worked in every layer of the capital stack. And
it's true.
It is kind of true. And I do find that some perspective and some respect, some real appreciation comes from knowing the fundamentals of how each level operates. So good deal structuring comes from experience and creativity, but also technical skills, right? You just need reps. And the good thing about banking is you get the reps in. In terms of your question, what does it take to be, an effective sub-debt or, its first cousin mezz lender? I think it's a thick skin, right? I think it's the toughest asset class to sell. If you're a senior lender, you have the stick of collateral and covenants. If you're an equity investor, you have the stick, so to speak, of influence. You can vote at board meetings. If you're a subordinated debt or mezzanine lender or investor, you have neither. And so you're really relying on relationships, disclosure, moral suasion, trust, respect. And that trust, it has to really, really, really be earned. You have to create value every step of the way because you just don't have hammers. And so I think to be effective in the role, you need some of the technical skills. You need some real salesmanship because you really have to think through what the value proposition of subordinated debt or mezz debt is. And you need to have the relationship skills and the capacity to be able to continue to stay close to your portfolio companies and add value when you don't have a hammer.
Yeah, great perspective. Well, you clearly had those skills and many more because after Vancity Capital, you went on something of an entrepreneurial adventure and you founded your own sub-debt fund, First West Capital, very well known in Canada. Can you tell us a little bit about that?
Yeah, so when I left Vancity, it was in the middle of the 2010 recession. Well, I guess it started in 2008, but 2010 was a pretty bleak time. You know, there wasn't a lot of capital flowing in the marketplace. There were lots of hemorrhaging companies. It was a full-on recession. Vancity specifically, you know, during that period of time, there was an executive change and a change in emphasis and a real focus on socially responsible investing. And Vancity, I would say, during those years, had not quite put a pin in what it meant by ESG or socially responsible investing. It's now very, very clear, you know, what it means to that organization, but it was very introspective during those years. There was this crazy sort of macro environment going on and this micro process of reflection in terms of defining ESG. And so where I found myself professionally was, you know, even if there's, and this actually gets back to my sort of development economics roots, having worked in Russia, I believe entrepreneurship is a force for social good. I believe it's social good in and of itself to create high quality employment, to innovate, to engage in R&D, to generate export activity. We all know how expensive it is to live in a place like Vancouver or Canada. So keeping our kids engaged, employed, productive, and at home and contributing to, you know, our country's success, to me, that's social good. Vancity had an evolving and more ESG focused definition of impact. And so I found myself in 2010 thinking, you know, these companies deserve financing. They might not be ESG focused. They might just be innovating, creating employment, exporting. But I believe in my heart of hearts that that too is social good. And so I wanted to find a way to get out there and support these great entrepreneurs. Banking can be great, but very formulaic. Equity is highly selective, and there's a space in between that calls for a little bit more creativity, but with a debt product. And I really felt that there was an addressable market there. There was an opportunity to do it better. You know, there weren't a lot of providers at the time, and I really felt that there was an opportunity. So, but, you know, I'd been an employee my whole life. So I went out and talked to a few people. Interestingly, talked to Terry Holland, who's now my business partner at Krystal. And I said, look, Terry, I've got this idea. And he's like, it's a great idea. We can make that happen. And then I went out and I talked to First West Credit Union. And I said, look, I've got this idea. And First West in particular was just super keen on this. They're like, we love this idea. Credit unions in general are heavily concentrated in cyclical, low margin residential real estate, and they needed yield. They needed diversification. And so they were super excited and they said, we'll write you a big check. You can start tomorrow. Let's go. And so I went back to Terry and I said, you know, they're going to write a bigger check. We're going to move faster. So I'm going to take this other route. And he said, absolutely the logical choice, no harm, no foul. And off we went and started with no portfolio, no employees, no phone number, no desk. We literally, you know, we couch surfed for a number of months. We were profitable by month 7. We did our first deal probably 4 or 5 months in, and we're committed to best-in-class processes, right? We built everything from the ground up. We didn't inherit legacy systems. We didn't inherit legacy team members. Every brand choice, communications choice, portfolio choice, adjudication choice, underwriting choice, business process, CRM. Everything was hand-selected. Blank slate. And we were committed to excellence. So we built a great portfolio, but we also built a great business, one that really focused on right-sizing processes. I would say this seed of an idea fell on fertile ground inside First West Credit Union. First West Credit Union was very, very supportive. And after about, the initial commitment was sub-debt only, BC only, $60 million commitment. Within a year and a half, the credit union came to us and they said, "We love what you're doing. How big can you get and how fast can you do it?" And we said, "Okay, we can grow, but we have to expand beyond BC's borders in order to do it. We need the geographic expansion." And thus began a journey to Calgary, Edmonton, Winnipeg, Toronto. We did a transaction in Quebec as well. So we expanded geographically and we built a strong foundation and scaled that business. So that's really the entrepreneurship experience. Took a professionally sort of experienced and developed eye, identifying great companies, and then built our own great company around financing those businesses.
I love the analogy of the seed falling on fertile ground. It sounds like it was great timing. I'm sure we have members and listeners that are feeling that entrepreneurial itch too, right? I mean, what advice do you have generally for people that are thinking about going it alone?
Yeah, mentorship and ownership, I guess. I walked away from First West Capital. At the end of the day, we had a difference in strategic view and I had shadow equity, but, not the real thing. And so when you don't actually have ownership, when your strategic visions start to part ways, you don't have decision-making control. So ownership is really important. But I think going it alone is tough too, right? I like to collaborate. There are some types of work that I like to do alone, but when it comes to really interesting brain food types of challenges, I like to spar with people. I like to whiteboard. I like to brainstorm. And you can get that by engaging a team, but no team is ever going to be as engaged as an owner. So I think partnerships can be really, really challenging. I've had a couple in my life that were real energy vampires. At the same time, I think maybe getting into a position where you have the controlling block of shares, but incenting your key management team through ownership and, putting together a great board and giving them some options or, a small equity stake so that they're equally aligned is really, really important because it's lonely and hard work to build a business on your own. You need to create those supports around you, and the supports are more effective if they're aligned through ownership.
Really terrific insight. And we are going to circle back to governance a bit, I think, later on. But let's fast forward now to the present. So managing director at KGP, congratulations. Obviously, you mentioned that's a shift. You've now seen every layer of the capital stack. How do you like being in the equity game?
Well, this is, where I want to spend the rest of my career, right? This is kind of the pinnacle as far as I'm concerned. The work with entrepreneurs is no different than what I've been doing for the last 20 years. So it still relies on relationships. Equity is easier to sell in some ways because, the value proposition is so compelling. So I'm loving being in the private equity world. I work with a small, agile, ninja, super, super smart team. So it's, the benefits of some level of scale, but also all of the family feel and intimacy that comes from a small ninja team. So I'm enjoying the people that I work with. I'm enjoying the book. I enjoy working with entrepreneurs. And I'm really excited, as we bring new companies into the fold, to watch the full cycle growth. In my old life, eventually a loan would get paid out and often sell a few years later and you get no upside from it, even though you've been part of building that value. Right. I'm really looking forward to that sort of full cycle experience where you get involved, you lean in, you help to create value, but then you monetize and you get to participate in that value that you helped to create. So this is absolutely where I'll be spending the rest of my career.
Very cool. You've mentioned a couple times around boards, governance. You've served as a director on multiple boards. I can see why. Like, firms would be lucky to have an expert advisor like you in their corner. But maybe you can explain, just for the folks for whom it's a little bit new, like how do you think about the role of the board versus the role of the C-suite or management? Can you just give us sort of the 100-foot view?
Yeah. Well, a board's fiduciary responsibility is to the company itself, and that's different in Canada than in the US. In the US, a board's fiduciary responsibility is to the shareholders. So it's a little bit different in Canada. And so there's always this question of, which hat are you wearing when you sit at the boardroom table? And ultimately, your responsibility is to do things that are in the long-term best interests of the company, of the business. And so, the board's responsibility is to, number one, recruit and manage the CEO. So the CEO reports into the chair of the board. That's an important reporting relationship. And the board's role is oversight, not doing, but really providing that strategic oversight, that accountability, asking good questions, getting to know the business well enough that they can address the agency issue that can come up with management, right? Management, they're in the business. They try to be strategic, but at the same time, they're worried about protecting their jobs. They're worried about protecting their influence and power base. And their actions hopefully are consistent with the best interests of the company, but at times they may not be. So boards always have to think about the CEO reporting relationship, making sure they've got the right person leading the charge, making sure that they're critical, but in a constructive way, of the information that management presents, recognizing that there are these agency issues and potentially different biases, and then really trying to ask very high-level strategic questions that make management think, that add some value, that bring in perspectives from outside industries or jurisdictions, and the benefit of experience, right? Management teams often are younger than directors. Directors see an awful lot, or they have diverse industry experience. And so it's really the role of the director to bring in that diverse experience and perspective and share them with management in a way that is relevant.
Yeah, that's wonderful insight. I was going to ask what makes a good director, but you've more than amply responded. Thank you. So sort of a question around PE and governance. So my understanding around private equity firms, when they make an investment in an operating company, they reserve the right to appoint board members. So it's kind of a two-part question. One, is representation on the board usually proportional to ownership stake? So let's say you make a 60% investment and there's 5 board seats. Would the negotiating starting point just be 3 seats? And then the second part of that question, how often does ultimate voting control and board seats become a big point of contention in negotiations? So I think there's a lot there.
Yeah. Yeah. So if we're investing for a control position, we will want representation on the board. Do we need to control the board? Not necessarily. Every time we make an investment, we have a shareholders agreement, and the shareholders agreement specifies certain decision-making rights, irrespective of ownership position. There are some decisions that we insist on being involved in, regardless of what percentage we buy. So it doesn't necessarily come down to the number of board seats. It can. We want to be on the board. We want that level of influence, disclosure, and conversation. But it's also, maybe more importantly, a function of what's in the shareholders agreement, including those key decision-making rights. So does the number of board seats become contentious? No, not in my experience. And I think, and I know Terry would say in his experience on boards, that rarely does it come down to a question of who outvotes whom. Decisions are almost always consensus-based. Getting to consensus can be challenging, but if you don't get to consensus, you have bigger problems. I think that's not necessarily the case in public company boards, and who knows, perhaps not even on larger private company boards. But in the mid-market, our experience is that effectively decisions are made by consensus. And the hardest thing to negotiate going into a deal is not the number of board seats, but the nuts and bolts of the shareholders agreement around key decisions.
Okay. You brought up public companies, and the G in ESG stands for governance. I know you work with private companies and smaller companies, but just given how widespread ESG has become, are you or your counterparts thinking about the governance function differently today than, say, 5 or 10 years ago? Has anything changed in the private market?
Yes, I think things have changed. One further point is that the focus on ESG, like the E and the S, so the G is shifting a little bit, but has always been important. There's more emphasis on E and S going forward. And it's as much about employee engagement and retention as it is about making the world a better place. These things matter to the millennials in our workforce. And if it matters to them, it matters to us.
Yeah, human capital management metrics are something that we teach, actually. It's become increasingly important both for operators and for the analyst community to understand what they mean. So that's a great perspective. Are there any books, authors, thought leaders, podcasts, things that you're into that you recommend our listeners check out?
Oh, you're going to hate my answer to this. Even through business school, I could not read business books. I just find them so dry. So I escape into fiction.
That's great. No, I love that answer.
Actually, you know what I do? So actually, this is nonfiction, but it reads like fiction. Red Notice, if you've not read Red Notice. So Red Notice is about an American hedge fund manager who went and lived in Moscow during the crazy era of privatization. And it's where the Magnitsky laws come from. So it's a great read, but it is the closest thing to a business book that I can recommend to your listeners.
You're not the first person to recommend it either, by the way. We chat with a lot of folks. That's really interesting. Okay, so kind of another random question. What's your best networking tip for our listeners?
Yeah, peer mentoring. So, I've been involved with a few different organizations over the years that offer peer mentorship. The first was Nancy McKay. It was great. I've been a member of YPO, which is the Young Presidents Organization now for several years. It's become a huge part of my life. And both organizations basically function on the idea of getting anywhere from 7 to 14 non-competing CEOs together in a room with a structured format to talk about challenges that they face. Sometimes it's business, sometimes it's personal, but it's a way to unload and share your experiences with others. But it's a super efficient way. It's almost like a life hack, right? If you're facing a challenge, whether it's HR software or regulatory issues or, manufacturing real estate costs in the Lower Mainland, you can get others' perspectives quickly, efficiently, with great data. So that would be absolutely my life hack for, that's what I would recommend to folks. And in fact, we're trying to do it in our portfolio. We're convening all the CFOs, for example, across our portfolio companies to share best practices, challenges, because these CFOs work in one company and they could get siloed in an industrial park in Delta, for example. Right. Yeah. Bringing them together allows them to cross-pollinate and learn much, much more quickly. And so I think this whole idea of peer mentorship is really, really valuable and can be applied in a bunch of different ways.
I love that. In an organization of learning and training and development, that whole idea of cross-pollinating and just getting exposure it really resonates with me, and I hope with our listeners too. We're coming up on time. You've been incredibly generous with yours. I really appreciate it. There is one question I try to ask all of our guests. If you weren't MD at Krystal right now, what would you be doing?
In my imagination or practically speaking?
The floor is yours.
Practically speaking, I would probably write fiction. In my imagination, I would be a Jackson Pollock style painter of large canvases.
Incredible. Well, and what a great hobby. Where can people go to learn more about you or about KGP? Are you active on social media?
LinkedIn is the only two. I do two social media. So I do LinkedIn, and you can find me at Kristi Miller through LinkedIn. I'm also on Strava because I like to bike. So those are the only social media that I do. I'm old school and relatively private, so you won't find me on Facebook or Twitter or Instagram. And what was the other question?
Just if people could, find you or information about the firm as well. I mean, we can put the link to the website, the company website, in the show notes if you're okay with that.
Absolutely. So it's Krystal Growth Partners is the name of the firm, and it's Krystal with a K, so Krystal, and the URL is krystalgp.com.
That's wonderful. Kristi, this has been absolutely awesome. Thank you so much for your time and insight. Let's keep in touch.
Thank you so much, Kyle. You've been super generous.
Thanks for listening to this episode of Net Learnings. This podcast is powered by CFI, an organization on a mission to enhance the skills, knowledge, and productivity of finance and banking professionals. If you enjoyed what you heard in this episode, make sure to follow Net Learnings wherever you listen to your favorite podcasts, or visit us online at corporatefinanceinstitute.com/podcast. See you next time.